Global Custodian recently spoke with Chris Olton of Prime Rate Capital Management about the U.S. Treasury's Guaranty program for money market funds.
Well, in the States, money market funds have been around for about 30 years. They grew and developed largely because there are uncertainties about the security of interbank credit lines.
How concerned are fund managers and institutional investors about bank credit risk?
And I think if you'd asked this question 18 months ago, you would have had an answer of quite concerned. If you were to ask the question now, of course everyone is extremely concerned. It's the one big risk that people have had to deal with in the last 15, 18 months has been credit risk, although actually what we've seen so far has been more typified by liquidity risk, but underlying investors' concerns have been about credit.
The U.S. Treasury's proposed guarantee program for money market funds must be approved by the U.S. Congress and overcome practical challenges to become a reality.
So there's a political goal and there's a political challenge that has to be overcome. Then there's the practical issues of actually putting this in place. The mechanics, because part of it is the two bits really. There's underwriting the underlying securities, so that if there is a default or there's an issue on one of the underlying credits, then there is also the US Treasury saying that it'll buy back asset-backed paper from money market funds themselves. So it's not just underwriting the par value, it's actually providing some secondary market liquidity, which is actually probably just as crucial because that's the bit that's missing.
But liquidity and credit risk shouldn't be the only things on investors' minds.
The last few months people have concentrated very much on liquidity risk, they've concentrated on credit risk. A new level which I think has been tended to be ignored is straight market risk. One of the reasons that money market funds have such tight investment parameters is so as to ensure that the revaluation of those portfolios doesn't expose investors to market risk. And so very little interest rate risk is allowed, very little credit risk, very little liquidity risk. It's all intended to keep things very, very safe. And of course, we've heard an awful lot of talk in the last chaotic few weeks with people saying that really the only place now to be is in the gold market or in the or the energy market or in the government market with treasury bills. And then we see treasury bills yielding negative interest rates so that you're paying the government to take your money. You see oil going up $15, $16 in a day. You see gold making similar moves. Gold was trading at $300 not that long ago. It's now at $800, $900. At what level is it safe to buy? These assets all hold huge amounts of market risk, which, because people have become so terrified of liquidity and credit risk, they assume that those are the only risks there are, but of course it's not. Buying a commodity, buying a stock, buying any asset at the wrong price is just as dangerous as buying the wrong asset.
For Global Custodian, I'm Eric Hornbeck.